Hello, everybody. Thank you for coming out. It's nice to see everybody here on a Wednesday after a busy night, so we appreciate you taking the time to come to a Mercatus Center event. I'm Aaron Merrill with the Mercatus Center. Our focus is the intersection of law and economics and public policy. And to that end, today we have a presentation from Randall Holcomb, who's the DeVoe Moore Professor of Economics at Florida State University, where he has taught for 23 years. So just before he gets started introducing the actual workings of a value-added tax, do a little housekeeping notes. The yellow surveys in front of you really help us determine how effective these courses are for you, how useful you find them, and gauge the level of interest in certain public policy topics. So if you could fill those out before you leave, you can hand them to either myself or to Megan outside. We would really appreciate it. It helps us put your time to good use. So we appreciate your help. So without further ado, Professor Holcomb to introduce the value-added tax.
Thank you very much, Aaron. I'm delighted to be here, and I appreciate the Mercatus Center having me up to give this talk. I've heard rumblings about the value-added tax ever since I began my career as an economist decades ago. From time to time, it comes up that somebody proposes we ought to have a value-added tax in the United States. And one reason for that is most other countries do have value-added taxes. So the issue is always going to be there, sometimes under the surface, sometimes bubbling to the surface. And it'll be interesting to see, this Deficit Reduction Commission is meeting now. They're going to report in December. And I've heard that one of the things that they might recommend is a value-added tax. I've also heard some people suggest no way are they going to recommend a value-added tax. So we'll see. But nevertheless, because it's used in so many other countries around the world, and because right now we're facing some budgetary issues ourselves and wondering how are we going to balance the budget, the value-added tax is an issue now, but it's going to continue to be an issue just because of its widespread popularity. So where I want to start off is to just explain what is a value-added tax. I didn't want to go that many. There we go. A value-added tax, like the name implies, is a tax on value added. So let's go through a simple example, and we'll make things a little more complicated later on, but let's go through a simple example and see how a value-added tax works. Let's say that we're manufacturing a baseball bat. In this example, I'm assuming, somewhat unrealistically, that the logger goes out and with no other investment in resources cuts down enough wood for a baseball bat, which is worth $4. So that logger's wood is worth, to make one baseball bat, is worth $4. The logger sells that to a sawmill. The sawmill turns that into lumber that's going to be a baseball bat. The sawmill's lumber is worth $7. So we're assuming that the logger starts out with nothing, creates $4 in value with enough wood to make that baseball bat. The sawmill now takes $4 in worth of wood, turns it into lumber worth $7. The value added is $3. The sawmill sells that lumber to a bat manufacturer who manufactures a baseball bat. That baseball bat sells at wholesale for $15. So the bat manufacturer takes $7 worth of lumber, turns it into a $15 bat. The value added is another $8. So the bat maker adds $8 in value. And then the retailer turns around and sells you the bat for $25. So the retailer turns that bat that was purchased for $15 into a $25 bat and adds $10 in value added. We might, if we're really interested, step back sort of philosophically say, does the retailer really add any value to that bat? Isn't that bat just as good when it comes out of the factory? And I could argue to you, well, yes, actually the bat is more valuable at the retailers because they provide a place where you can try out different bats and they have them displayed on racks and so forth and so on. But really for the value-added tax, that's irrelevant because the way value-added is calculated for purposes of the tax is you take the cost of your inputs, subtract them from the price that you sell your good for, and your value added is the price that you sell the good for minus the cost of the inputs that went into producing the good. So by definition, the value added is $10 there. So it looks like these columns aren't, somebody's modified my slides. So it must have been the people at the Mercatus Center. So the value add, this $25 is supposed to be over there. So the value added adds up to $25, which is just the price that the retailer charges for the bat. But that makes sense if you think about it because the value of a final good is equal to the sum of the value added at each stage of production. So let's say that we're going to charge a 10% value-added tax. Now, the way the value-added tax works is every seller pays the tax on the seller's value-added. So if the $4 in value-added for the logger, that's 40 cents in value-added tax, 10% of the $4. 30 cents in value-added tax go for the sawmill. The bat maker pays 80 cents in value-added tax. The retailer pays $1 in value-added tax. And then, whoop, this column should be over there. So the value-added, the 10% value-added tax adds up to $2.50. Which makes sense because the value added is the total price of the good, right? The sum of the value added is the total price of the good. So 10% of the price of the good is what the 10% value added tax is going to add up to. Now, another way that we might tax this same tax base would just be to have a retail sales tax. Right? Because if you look at the computation here, the 10% value-added tax raises $2.50. If we had a retail sales tax on the $25 bat, 10% retail sales tax be $2.50. And in fact, if we wanted to go through some economic analysis on this, what we would find is that the burden of the tax is going to be the same whether we put the tax on the suppliers through a value-added tax or on the demanders with a retail sales tax. Because of tax shifting, if we were going to do a lecture on tax shifting, we could go into this in more detail, but because of the way taxes are shifted, it doesn't matter whether you put a tax on suppliers in a particular market or demanders in a particular market. The burden of the tax is going to be the same either way. So as far as the economic effects of the tax, the economic effects of a 10% retail sales tax would be the same as the economic effects of a value-added tax. One thing we might discuss, I'm not going to talk about it too much, but is worth considering, is why would we have a value-added tax? Why would we use a value-added tax rather than a retail sales tax? The sales tax, one thing the sales tax has going for it is it's a lot less complicated. It puts a lot less burden on taxpayers as far as compliance, on the government as far as administrative costs. But on the flip side of that, advocates of a value-added tax will tell you it's harder to evade. And so especially when you get into higher tax rates, that's one argument that the proponents of a value-added tax will make for the value-added tax. So you see basically how the value-added tax works. This final column here shows you the price of the good if the value-added tax were included at each stage along the way. So the bat ends up in a VAT country, the bat ends up costing $27.50, including the value-added tax. If we had a sales tax instead, it would be $25 plus tax, plus $2.50 tax. So it's the same price either way. So how do we calculate the value added tax? The value added, like we saw in the previous slide, is sales, your sales, minus the value added at earlier stages of production. So just for accounting purposes, we take your total sales and then we subtract out the value added that occurred in earlier stages of production. So let's go back to the bat maker. In the previous slide, we said the bat maker pays $1 in value added tax. How do we figure that? And if we're doing the accounting to keep track to figure out how much the bat maker pays on the sales tax, he sold the bat for $25. So he owes $2.50 in value added tax minus whatever's been paid at previous stages of production. The 80 cents from the bat maker, the 30 cents from the sawmill, and so forth. So we take the $2.50 minus the taxes that were paid before equals the $1 that the bat maker now owes for the value added tax. Let's see. There we go. So when you look at the method by which the tax is calculated, taxpayers have to have records to show, like in our bat maker's example there, that 250 minus and so forth. They have to have the records to show those taxes have already been paid. Otherwise, if there's no records to show, for example, that the sawmill paid 30 cents in value-added tax, then the retailer is liable for that tax. So there's a kind of a self-enforcing mechanism here where if one taxpayer along the way evades the tax and doesn't pay the tax, then the next person in the chain of production is liable for that tax. Okay? So there's a self-enforcing mechanism, and of course everybody who's purchasing inputs wants to get the receipt from the seller that says the value-added tax has been paid, because that receipt, essentially it's as good as cash to the person who's paying the value-added tax. Right? Again, if you look at the calculation up there on the top line, $2.50 minus 80 cents, minus 30 cents, and so forth. Well, if you have the receipts that show that those taxes have been paid, those receipts are as good as cash to you because it reduces the amount that you have to pay. That's how we eventually get that tax down to $1. But you can see that because of the fact that the tax is enforced this way, compliance is enforced this way, the government has to have good records to make sure that the claims are legitimate. See, so when the bat maker or the retailer says, well, it's $2.50, but 80 cents was previously paid by the bat manufacturer, 30 cents was previously paid by the sawmill, the government has to have the records to be able to verify that that's the case. Otherwise, sellers could just claim, well, here's previous taxes that were paid, and if you can counterfeit those VAT receipts, that's as good as cash. So because of the record keeping that's required for the value-added tax, the administrative and compliance costs are really high. That there's a lot of record keeping that has to be undertaken by taxpayers, and there's a lot of record keeping that has to be undertaken by the government to verify that, in fact, the taxpayers' claims are legitimate claims. If we look at the value-added tax around the world, and here I'm focusing particularly in the European Union, we can see that it's a major share of revenues from EU countries. 30% of EU country revenues come from the value-added tax, and it's the largest single source of revenues in the EU. So it's pretty big tax. If we look at the VAT rates, we consider the tax rates, we can see that tax rates around the world are pretty high. The lowest I have here is Canada, 5% VAT rate. Switzerland's 7.6%, but everybody else is in the double digits there.
Can I just ask you a question?
Sure.
Canada has 5% VAT. Do they have an income tax on top of that? Or are you talking about countries that have an income tax in addition to that, or just a VAT?
Yeah, they have an income tax, and also Canada has provincial sales taxes on top of that, something that's not the case in the EU. Yeah, they do. They have income taxes and provincial sales taxes in Canada in addition to the VAT. Whereas in the EU, as I'll talk about in more detail in a moment, they don't have other transaction-based taxes. And you can see the rates get pretty high. Sweden, 25%, Norway, 25%, Denmark, 25%. So they're pretty substantial VAT rates in the EU countries in particular, but around the world. In fact, right now, the EU requires that all member countries have at least a 15% VAT rate, but you can see that I don't see any EU countries that really come close to that. So they're tend to be above the 15% minimum required rate. Yeah.
You're talking about keeping the burden of a VAT. And I was just curious, countries that have an income tax, how do you characterize the aspects of the additional record keeping attributed to the VAT that beyond what taxpayers have to do to comply with the income tax?
Yeah, if I understand your question, it's a completely separate record keeping. So it might be convenient if you could use your income tax accounting to also account for your VAT. But it's a completely separate process of record keeping. So separate records that have to be kept for income taxes and for the VAT. So the compliance costs, depending upon how complex you think the VAT is, which it's pretty complex, the compliance costs may be double. Yeah.
Doesn't that assume, though, that the only way to implement a VAT is the European, the standard way? I mean, couldn't you essentially rewrite the tax code so that besides the income tax, there's a VAT component of the income tax and use the income tax records and achieve exactly the same kinds of goals without as much of the overhead? I mean, it's a definitional issue in terms of how it's administered.
You might be able to do that. I don't know. When we talk about the VAT for the United States, everything is very speculative because people have talked in general terms about let's implement a VAT. But nobody has said specifically, here's how we ought to do it. A lot of the references to Europe, and I'm using a lot of reference to Europe myself. So if we were going to do that here in the United States, certainly one thing we would want to look at is there some way to design this tax so that it'll have less of a burden as far as compliance, administrative costs, and so forth, less of a burden than it does in other countries. I don't know. I would hope if we go that route that we look for ways to reduce those costs. But on the other hand, the EU's had the VAT for decades, and it's a pretty heavy compliance and administrative costs there. My clicker here seems only semi-functional. A little bit of the history of the VAT. France adopted the VAT in 1954, so that's the origin of the VAT. Other countries, in particular Britain, looked seriously at the idea of adopting the VAT, but then rejected it. But the European Economic Community decided, for the sake of harmonization of taxes, that all of the countries would adopt a VAT. At the time, if you go back to the 1960s, there were a variety of transaction-based taxes in Europe. Sales taxes, turnover taxes that are notoriously inefficient. The European countries had very different types of tax systems. And that's one of the justifications that's sometimes given for trade barriers, that you'll hear manufacturers in one country say, we need protection from foreign competitors because their tax system gives them this advantage or that advantage over our domestic industry. So differences in tax systems are often given as a justification for enacting trade barriers. And so when the European Economic Community, now the European Union, wanted to essentially establish a big free trade zone in Europe. I mean, that's one of the big benefits we have in the United States. Being a big country, there's no trade barriers among all the states. So it's a huge advantage for commerce, and Europe wanted to share that advantage also. But because of the arguments that there are different tax systems that provide advantages to manufacturers in one country over another, the European Economic Community countries agreed that they would harmonize their tax structures so they didn't have to have exactly the same tax systems, but they would have tax systems that were similar in broad parameters. And one of the things that they agreed on was that they would use a value-added tax as their transaction-based tax. So to get rid of the sales taxes, the turnover taxes, and so forth, and replace them with the value-added tax. So the reason that the EU countries all have a VAT is because they agreed to it for purposes of harmonization of their tax structures, so that when they drop the trade barriers to make Europe essentially a big free trade zone, that manufacturers in different countries would roughly be put on equal footing. So that's the rationale for, that's why the VAT was adopted in Europe. It wasn't that country by country they said, oh, I think we'll do what France is doing, but rather that all of the countries agreed for tax harmonization purposes, they would all rely heavily on the VAT. And then once adopted in the EU countries, the VAT spread around the world. So now most countries around the world use a VAT. And what we see if we look at what happens to the VAT is once the VAT is adopted, the revenues come in higher than originally projected and rates tend to rise. It's interesting if you look. When the EU countries adopted the VAT back over a series of years from 68 to 73, country by country, they said they were going to adopt a VAT in a revenue neutral manner. So what they were saying is, we're going to change our tax structure, but we're going to raise about the same amount of revenues with the new structure as the old structure. And it's interesting when you look at over a period of years, you look at individual countries, and when that VAT is adopted, you see a spike in revenues after the VAT was adopted. And we also see that the VAT rates tend to rise over time. If we look at the initial rate, the only country I have here that has a lower VAT rate now than when it was originally adopted is Canada. Canada's rate went down from 7% to 5%. But if you look at all of these other countries, and I mean this isn't a comprehensive list because just about every country has a VAT, but it's a pretty good sampling of countries, and you see that the rates went up pretty substantially. If you look at all of these countries, the average rate, the average original rate was a little under 10%, and you look at the rate now, and it's nearly 16%, the 63% increase in VAT rates from the time the tax was introduced until the present time. So one of the, I guess I'll call it a feature. One of the features of a VAT is it tends to be a pretty good revenue generator. I'll call it a feature because some people like that about the VAT and some people don't. I mean, if you're thinking, I think we're taxed too much already, want to have lower taxes, more limited government, VAT doesn't seem like a very good option because it has a history of being a revenue generator. And once it's instituted, it's easy to raise the rate once the tax is in place. On the other hand, if you're thinking, federal government has a lot of obligations and somehow we need to cover them and maybe we ought to look at ways to enhance revenues, well, the VAT is a proven revenue enhancer. So I think if we in the United States adopted a VAT, it would bring in more revenues. That's something that some people like about it and some people don't. Let me talk a little bit more about some of the administrative and compliance issues related to the VAT, because I gave you a simple example with the bat manufacturer so we could get an idea of what value added is and how value added is calculated for purposes of a value added tax. The compliance costs are pretty high for a value-added tax, and partly for that reason, maybe for other reasons, in the countries that have a VAT, some sellers are exempt from the VAT. So if you have a real small business, your gross revenues are small, that might be one criterion, and it varies from country to country, but that might be one criterion that would exempt you from the VAT. And if you were a retailer, that would mean that when you make a retail sale, even though there's VAT included in the earlier stages of production, if you're an exempt retailer, you're not going to add any VAT to the price of the good. So the actual VAT rate will be a little bit lower than the posted rate because the retailer is exempt. If you're an intermediate producer, that VAT gets picked up later, because you remember we talked about the way that the VAT is calculated and the way the VAT is enforced. So let's say you're a small manufacturer of some little part that goes into making some final product, and because of the particular country's laws, you're exempt. Well, then if you sell an intermediate product to somebody else who then uses it to produce a good and sell it again, the later seller doesn't have the receipt from your value added, and so the later seller is liable for paying your value added. I mentioned it's an enforcement mechanism that may keep people from cheating on the tax, but also for exempt suppliers, if somebody in the supply chain is exempt, their tax liability then gets picked up later on in the production process. Some goods in VAT countries are zero rated, and what zero rated means is that there's no VAT that's levied on that particular product. For example, healthcare supplies might be zero rated. In a lot of EU countries, newspapers are zero rated. So that means that for zero rated goods, no VAT is paid on that good. Well, so if in earlier stages of production, somebody had paid the VAT, then with a zero rated good, there's a rebate of the VAT that has been previously paid. So let's say that a company that's manufacturing shirts buys cotton to manufacture shirts. Then the VAT is paid on the cotton, then the VAT is paid on the shirt. But let's say another company buys that cotton to manufacture bandages. And let's say bandages, because they're medical supplies, are zero rated. So then the cotton that goes into making the bandages, the VAT that's already been paid on that is rebated to the seller of the bandages, so that effectively there's no VAT that's paid on that particular good. If you look at the sales tax in the United States, that varies from state to state, but in Florida, my state, groceries are exempt from sales tax. And actually, see, exempt means something different with the VAT than it means with the sales tax. So there's no sales tax on groceries. In VAT lingo, groceries would be zero rated. But if you were to do that with a VAT, since there's already been some VAT paid at earlier stages of production, to actually have a zero rate, you have to rebate the tax that's already been paid that's built into the good. So that's an additional complication that exists with a VAT. Of course, you don't have to have zero-rated goods. And the VAT would be a bit simpler if you didn't have zero-rated goods. But at the same time, you don't have to have sales tax exemptions either. And yet, if you look across states that have sales taxes, they all exempt certain things from sales taxes. Also, in VAT countries, there are different rates that are charged for some different goods. So some goods aren't charged a full VAT rate. So you have multiple rates that adds an additional complication to calculating a VAT. Another complication is the way that capital investment is treated. And in my simple example there with the baseball bat, everything in the chain of production was essentially raw materials that were being increasingly finished until we made a baseball bat. But if we actually were selling that baseball bat at a sporting goods store, not only would that sporting goods store buy inventory, bats, it would buy cash registers, it would buy shelving, it would buy lighting and carpeting for the store and so forth. There are a lot of other inputs besides just the inventory. So if we're designing a VAT, we have to figure out how are we going to take account of those other inputs. And in practice, the way it's done in the EU is by depreciating them. It would be possible to expense them, but then, like if a new store opened up, it would be likely that the new store, because of all the capital investment, the new store would have much more in expenses than it would have in revenues the first year. And we could deal with that various ways by giving them credits and so forth. But in practice, the way this tends to be handled is through depreciation. So, just to give a maybe overly simple example, you buy a cash register, which you figure is going to last about 10 years, and with straight line depreciation, then you take 10% of the value of the cash register every year. Of course, there are different categories of goods, just like with depreciation in the federal income tax. There's different categories of goods, different types of depreciation, and so forth. So when we include capital investment, we consider capital investment as a part of the VAT structure, things become much more complicated. And again, if you go back and compare this with a sales tax, the sales tax is so simple because, here are my total sales. I pay that percentage, and that's my sales tax that's due. With the VAT, it's a lot more complicated to go back and calculate the value added, partly because of the way that capital investment is treated. So that's yet another complication in the VAT. The way that imports and exports are treated is significant for the VAT, and in one sense we might look at it as a feature, but when goods are exported, the entire VAT that's been paid on those goods is rebated to the exporter. And when goods are imported, the total value of the imported goods are subject to the VAT. So what this does is to equalize VAT rates across countries. Let's say that somebody in France buys a Mercedes-Benz. So that Mercedes-Benz is manufactured in Germany. As it crosses the border into France, the exporter gets a rebate of all the previous VAT that's been paid on that Mercedes-Benz. So it's exported tax-free. Then it's imported into France, and at the border again, the French VAT is levied on the Mercedes-Benz as it's imported. So every car that's sold in France pays the French VAT. Whether it's a French manufactured car, German manufactured car, American car, imported cars the VAT is levied on the value of the car as it's imported. Any exports, the VAT is rebated. But again, see, this is a bit of a complication to the VAT because first of all, there's an enforcement issue, and with a lot of these things, there are possible ways to evade the tax. And one way to evade the tax is to claim that you're exporting Mercedes-Benzes when you're really selling them in Germany. So when you apply for that rebate, there has to be somebody who's there to physically check to make sure, okay, the good is really leaving the country, because they're claiming a rebate for the VAT. That's one issue. Another issue is if you're collecting the VAT at every stage of production like that, and then you rebate the tax at the border, you've gone through all the administrative and compliance costs of collecting a tax, but you get no revenue. I mean, every stage along the way, every taxpayer is going through those administrative and compliance costs, but there's no revenue that's collected because the tax is rebated. And then let me talk a little bit about the VAT Register. And I've mentioned the idea of this already. As we've noted, because of the way that the VAT is calculated, it's your sales minus the VAT on previous purchases. Any claims you make for previous purchases, that's as good as cash to you. So we have to make sure under the VAT that if I'm claiming VAT has already been paid on part of my sales, I have to make sure that's actually really true. And so as a result, the government keeps track of every VAT transaction. So when that bat manufacturer sells that bat to the sporting goods store, the bat manufacturer reports to the government, here, I've sold this to the sporting goods store. Here's the value of those bats. Here's what I've charged the sporting goods store. Here's how much in VAT that I've paid. So all those records have to be kept so that we can go back and audit to make sure that when people are claiming that there's some previous tax paid, that it's really true that that previous tax was paid. So just keeping up with this VAT register is a pretty complex undertaking in itself. So when you look at the VAT, I don't think it's very reasonable to compare it to a retail sales tax because as we noted earlier, the economic effects of the two taxes are going to be the same. But then when you look at the administrative and compliance costs that are associated with the VAT, we see that those administrative and compliance costs are a lot higher with a VAT. So hopefully we're getting something in return, rather than just having a retail sales tax. But as I mentioned before, there is this auditing procedure and a sort of a self-enforcing procedure as long as we go through the administrative and compliance costs. And when you look at VAT rates, if you've got a VAT rate of 20% or 25%, it's awfully tempting to evade a tax like that. And so as a result, if you actually really want to collect the tax, you need to do a lot of monitoring to make sure the tax is paid. And still, there are so many ways that the tax can be evaded. I mentioned the exports. Another thing, again, I talked earlier about hypothetical example of a shirt manufacturer and a bandage manufacturer. But let's say those are the same companies. Let's say one company makes shirts and bandages. What they would want to do is to allocate a lot of their cotton purchases to the shirts so they can subtract out the previous VAT payments and not so much to the bandages. And just keeping up with something like that. Was it you're going to have a Treasury official standing there and watching the cotton go one direction or another? So it's pretty complex when you get into the details. The basic idea of it's simple, but it gets pretty complex, and there are pretty heavy administrative and compliance costs. Let me mention a few other issues related to the VAT. One issue is that some people argue that the VAT is regressive. Um, I'm not overly concerned about this, but I know, some people who are looking at the VAT are saying, compared to, for example, the income tax, where like the bottom 50% of income earners are paying like 3% of income taxes, compared to an income tax, if we went to a VAT, lower income people would end up paying for sure a bigger share of the VAT than they are of income taxes. And so that has led to various proposals to have VAT rebates for low-income people and so forth. Again, it's hard to say how this would play out if we actually had a VAT in the United States. But nevertheless, it's one issue that some people have considered and are thinking, we might want to do something to try to mitigate this if we actually do impose a VAT. Another issue is an issue of intergenerational equity. This issue applies if we're thinking about having a VAT replace all or part of income taxes. And I think probably the way it's been discussed mostly is as an add-on. But imagine somebody who has worked his entire life, paid income taxes, and you get ready to retire. You've already paid your income taxes on your income. Then you can go ahead and spend that income on which the income taxes have already been paid. Now, what if we shifted from an income tax to a VAT? Well, now, all that money that you already paid your income taxes on, now you have to pay VAT on those purchases also. And so there is an issue of intergenerational equity where if we adopted a VAT in place of all or part of an income tax, there's a transitional period where it would place a higher burden on people who are retired or close to retired. Another issue, and I think this is a big issue, is the fact that the VAT tax base is shared with the states. Right now, states already have retail sales taxes, and as we noted in economic effects, a VAT and a retail sales tax tax the same tax base. So if the federal government implemented a VAT, it would be taxing the same tax base that state retail sales taxes already tax. This is in contrast to the VAT in the EU, where the VAT is the transaction-based tax. They don't have sales taxes. They have a VAT instead of a sales tax. But if we adopted a federal VAT in the United States, it would be put on top of state income taxes. So this is for people who've studied economics in college. So you look at this, oh, that looks sort of familiar, like something that I saw before. But let me just use this supply and demand diagram to do some simple economic analysis as we look at this. And I'll tell you what my conclusions are. So if you have some economics background, then you follow along and say, oh, yeah. But if not, ask somebody who has economics background. They'll say, yeah, that's right. But here I have a supply and demand curve, and with no taxes, we're going to have this output Q in our market. So if we add a tax of the amount T onto our market, then the amount of taxes that we collect is going to be the tax rate, and that's this distance in here, this P plus T, our tax rate, times the number of units that are sold. Now, we have this downward sloping demand curve, so if we put a tax on a good, we know taxes discourage the taxed activity. And we see that in the diagram where the amount sold goes from Q to Q prime here, showing that the tax activity is discouraged by the tax. And the amount of taxes collected is the tax rate, this distance here, times the number of units that are taxed from the origin up to Q prime. And if I remember my high school geometry, the area of a rectangle is base times height. So if we multiply the number of units that are being taxed by the tax rate, we get the area of this rectangle, or what I've labeled T and B. All right, that's the amount of taxes that we're going to collect. We can represent that in the diagram. That's a geometrical representation of the total amount of taxes that are collected. But because the tax discourages the taxed activity, this area A, this triangle A, is what's called the welfare loss or excess burden of taxation. That represents the welfare loss from the reduction in the taxed activity because the tax discourages the taxed activity. Now, let's say that we, just for simple example, double the tax rate to S plus 2T. This would be, for example, if we're putting a VAT on top of a sales tax. See, so if we didn't have the sales tax already, then here's our VAT. But now we have a sales tax, then we're going to put VAT on top of that, taxing the same tax base. So now, by the same analysis, the amount of revenue I collect is U plus T, the rectangle's U plus T. So I'm gaining this amount U, but I'm giving up this amount B because the higher tax rate discourages more economic activity. So what I see is that in this simple example, if I double the tax rate, I get less than twice as much in revenues because the tax discourages the taxed activity. But the welfare cost of taxation is more than twice as much. In fact, with straight lines, the way I've drawn it here, is 4 times as much. The welfare loss is A, B, C when I double the tax. Okay, so what I see, so the lesson I get out of this is that if in this example, if I double the tax rate, I get less than twice as much in revenues, but the welfare cost of taxation more than doubles. So now let's apply this to putting a VAT on transactions in the United States where we already have a sales tax that's taxing that same tax base. So if I put my VAT on top of the sales tax, it's going to generate less in revenues than if I didn't already have a sales tax. It's going to it's going to increase the welfare cost more than in proportion to the amount of revenues collected, and especially to the point of the states. If the sales tax is its original tax, then we put a VAT on top of it, the state component is going to decline by this amount. That if we put a federal VAT on top of that state sales tax, state revenues are going to suffer as a result of the VAT that's put on the same tax base that states are already using to collect their revenues. So let me go through, I'm going to go through and give some sort of back of the envelope calculations that I did. All of this talk, by the way, is from a study that I did for the Mercatus Center, and there are copies of the study back here on the table. I see some of you already have them. In this study, I did some, I would call them back of the envelope calculations on the costs that a VAT would impose on our economy if we had a VAT in the United States. Don't take any of these numbers, even though I have them down to I have 55.6 down to a decimal point, but I guess if the decimal point is a billion, that's like rounding off to the nearest 100 million. But nevertheless, I mean, the numbers are illustrative because, what type of a VAT we would have in the United States, we don't know. I mean, we've just heard people speculate maybe we ought to look at having a VAT, adding a VAT to our tax structure. They use it in Europe. We've got a big budget deficit. We need to close that gap somehow. So what I did was to look at previous studies that have been done about compliance costs in countries that now use a VAT. And I applied that to the United States, and it looks like if we had a VAT in the United States, compliance costs would be around $55 billion a year. And that's just if the United States adopted a VAT that had compliance costs similar to other countries that have a VAT. And that's pretty much independent of the VAT rate, because you're going to be doing the same calculation whether the VAT rate is 5% or 10% or 15%. You just end up paying more in revenues. Yeah.
Do you calculate any offset if you're doing a revenue neutral VAT and taking people out of the income tax system to get income tax administrative savings?
Yeah, I didn't calculate any offset, but one reason for that is I think if we added a VAT to our current tax structure, we probably wouldn't take people out of the income tax system, but we might. I mean, one thing we might do is to say, you know, this group of people don't have to pay income taxes now that we have a VAT. So I didn't do that, and my conjecture is it's unlikely we would take people out of the income tax, but if we did, then there might be some offset. Again, my conjecture would be if we took people out of the income tax system at the same time as adopting a VAT, it would be the people who have low compliance costs anyway. You know, people who are filling out the short form and stuff. So, I don't know, but the short answer is no, I didn't. And then as far as administrative costs, I calculated that by figuring roughly the number of VAT returns that would have to be filed, and then looking at the current costs of the IRS and adding those administrative costs onto the IRS. So the administrative and compliance costs, again, it's back of the envelope calculation, so I'm not going to I'm not going to defend these numbers really strongly, but I think for purposes of illustration, we get an idea of the burdens that a VAT would impose on the country. It looks like, you know, between 0.4 and 0.5 of a percentage point of GDP. So maybe about 63 billion is just the calculation that I did on that. Then if you look at the excess burden of a VAT at various rates, and what's that excess burden? If we go back, the excess burden is the welfare loss that we calculate. It's that welfare triangle from the reduction in economic activity. So if we look at the excess burden and then we add to that the administrative and compliance costs, we get some idea about the total welfare cost of a VAT at various rates. 1% VAT would impose total costs of around $75 billion on the economy. 10% would be $234 billion. And then if we look, now we're looking at the same welfare loss. Here's the VAT revenues that we would collect if we imposed a VAT. And the way I calculated that, I mean, we talked about all of the complications that are involved in the VAT and trying to determine, different rates and zero-rated goods and maybe the prospect of evasion and so forth. But if you look at VAT countries, the countries that use a VAT tend to collect, for a 1% VAT, for every 1% of VAT, they tend to collect between 0.5 and 0.55% of their GDP. So for example, each increase in the VAT rate of 1% increases the VAT revenue by about between 0.5 and 0.55% of GDP. So just using that figure, and again, it's a back of the envelope calculation, but what I'm assuming is in the United States, the VAT would be roughly equivalent to the way that it's applied in other countries. Then here's the additional revenues that we would get from a VAT. And then if you look at the welfare loss from the previous slide, here's the welfare loss as a percentage of the revenues collected. And you can see for low VAT rates, the welfare loss is pretty high as a percentage of VAT revenues. And in fact, one study that I looked at in looking at the administrative and compliance costs of a VAT suggested that really, because of those high costs, it's probably not worth it to impose a VAT unless you have a rate of at least 10%. But I mean, the reason for that is the welfare costs tend to be pretty high as a percentage of revenues collected for lower rates. When we would impose a whole new tax structure, a whole new set of calculations.
I have a question about your 0.5, 0.55. Are you saying that, so there's reasons, different reasons when the 1%?
Yeah.
1% and 1%. And some of those reasons are cheaper investment, for example, goes into GDP, but is maybe outside of your back base. So that would be erosion of.
Yeah, I think consumption tends to be about like 70% of. Yeah.
Could be the interplay of the VAT with other taxes, income taxes, or other sales taxes.
Yeah.
Offsets that due to those interactions. Are you saying that the VAT, most of that, or can you parse what is the source of the 0.41 minus the 0.55? And there's also a zero-rated
Yeah,
exemption
yeah.
sectors. Is that factor, the difference between 100% versus 55%, what's it due to? Is it due to?
Yeah, no, that's a good question, and I don't know the answer to that. What I did was just look at, in VAT countries, the percentage they actually collected. You know, what each 1% of VAT rate was, what percentage of GDP that amounted to.
But if the
So-
theory was that the VAT extinguished GDP, in other words, that there was production that would evaporate
Yeah.
as a result of application of the VAT, then that calculation would not pick that up because the denominator is
That's right.
observed
That's right.
to GDP. So
Yeah.
I'm just confused as to be of interest to know that erosion factor, if it's just all explainable by investment, zero-rated exemptions, and
Yeah, and I think probably with a little research, I could get at some, you know, at the answer. But even there, you know, there's various estimates about the amount of evasion that takes place under a VAT. I mean,
that could be an explanatory factor. The only, I guess I'm saying is that the factor of the extinguishment of GDP, which you may be referring to in terms of this loss,
yeah, that's not in there.
that's a separate factor.
That's right. That's separate, and that's not in there because we're using GDP. Yeah, yeah.
You mentioned, you know, the evasion factor. Did you do any calculations on the opposite effect of the evasions that you're captured with the VAT? That today's cash economy totally avoids the income tax? You know, in other words, new revenue that escapes. I mean, that's one of the arguments for a sales tax and a VAT is capturing your gray economy.
Yeah, no, I didn't.
But that's offset in the other direction.
Yeah, I mean, again, if you go back to that figure of the VAT, each percentage point of VAT collecting between 0.5 and 0.55% of GDP.
That's just the net of the leakages, both positive and.
That's right. That's right. Yeah. Now, I looked at several studies that examined the impact of taxes on GDP growth. And so from that, looking at applying VAT as an additional revenue source, how would that affect the rate of growth of GDP? And so here, again, back of the envelope calculations, the revenue neutral VAT there we would apply a VAT, but we would reduce other taxes, so we would raise the same amount of revenue. The only effect there is the administrative and compliance costs that add a burden to the economy that's not there now. But as we increase the VAT rate, we get that excess burden that discourages economic activity and slows GDP growth. So I projected these starting from approximate 3% rate of growth of GDP, which is historically pretty close. Here's the growth rate that we would expect from various VAT rates if we added a VAT onto our current tax structure. Now how realistic is that to think? I mean, here I'm saying, you know, if we added a 10% VAT, our growth rate would go from in the neighborhood of 3% to 2.46%. I mean, is that a reasonable kind of calculation? If we look at countries that apply the VAT, here I'm looking at growth rates from 1999 to 2004. The United States, in fact, did have a 3% average annual rate of economic growth. If we look at the euro area, 2.1%, almost a percentage point lower. I've got a few other countries in there. The UK comes out the same as the United States. And here we see the same thing if we look at 2009, which we know was a tough year economically for countries, but nevertheless not as hard for the United States, for example, as the euro area. So I just put this up just to suggest, as I'm projecting the impact of VAT on economic growth rates, you know, say, well, is that reasonable to think that a VAT is going to have that kind of an impact on economic growth? If you compare the United States with countries that have a VAT, at least I would say it's not outside of our current observations of the US versus countries that have a VAT. So here, again, using these numbers, I won't go through every single number in the table, but then let's look at what this table shows. First of all, what I do is project ahead 10 years and 20 years the GDP at the slower growth rates. So let's say that we have a 3% VAT. Then 10 years out, our GDP is going to be 2.1% lower. 20 years out, our GDP is going to be 3.7% lower. Let's say we have a 7% VAT. Then 10 years out, GDP is going to be 4% lower. 20 years out, GDP is going to be 7.5% lower. Again, these are back of the envelope calculations, so I'm not going to put a whole lot of stock in the numbers, but I'll say this is illustrative. And I'll mention all of this is in this study. So these tables and the numbers are taken out of the study here. So here we have the percent GDP loss. Here, this is the dollar GDP loss. And then I look at the VAT revenues that would be collected at these various VAT rates. So we see, okay, we have the GDP loss, but we have these revenues that we get from the VAT. But also, because GDP is lower, we're going to have lower federal government revenues from other tax sources. If GDP is lower, so income is lower, that's going to lower income tax collections. And because GDP is lower, income is lower, and we're competing with that state sales tax base, state government revenues are going to be lower. Right? So we impose a VAT, we have a GDP loss, we get some VAT revenues, but we lose some federal revenues because we have less income that we're taxing. The states are going to lose some revenues. So the last row here is the net tax revenue increase. That is, when we look at the VAT revenues that we collect, minus the revenues that we lose at the federal level and the state level because of the slower GDP growth, what kind of net revenues do we end up getting? And we see if we project out 20 years with a 3% VAT, $91 billion in net revenues. That's VAT revenues minus the losses at the federal and state level. The GDP loss is 10 times greater. You know? So, and we can look at the other figures and we can see similarly, you know, here's 20 years out, the GDP loss is nearly 10 times as great as the net revenues that we can get. Now again, I don't want to put too much stock in the particular specific numbers here, but if you look at what's behind the numbers, I think the ideas are solid, even though we might debate about the numbers. That if we're adding taxes to our tax system, we're going to have a GDP loss. We'll collect some revenues from those taxes, but we're going to lose revenues from other tax bases. And if you project out 20 years, the new revenues that we're going to get from a VAT are insignificant, really. That we wouldn't end up adding substantially to our federal revenues at all. Is the United States a big government country? I mean, maybe if we were running these big budget deficits and we want to have a bigger government, maybe that's something we ought to consider. Maybe you know, we're looking across the ocean here and thinking maybe the United States should be more like France. But if you look at the numbers, you see that per capita government expenditures in the United States is just about at the same level as per capita government expenditures in France. In Sweden, they're a little bit higher. Per capita government spending in the United States is greater than in the United Kingdom, greater than in Germany, greater than in Canada. Now, as a percent of GDP, we're low. We're the lowest on the chart. But if you just look at per capita government expenditures, we're right up there with France. But, and how do we explain that? It's because we have higher income. And so one of the things to be concerned about is that, you know, the VAT might turn us into something like France, but it would do so not by increasing per capita government spending, but increasing government share of the economy because GDP growth is lower. And so we end up being a big government country as a percent of GDP, but we don't have the additional revenues to spend on our citizens. As I say, you know, in the United States, per capita government spending is about the same as it is in France. But we've got this huge budget deficit. Don't we need to do something about the budget deficit? Well, we see a lot of other countries have problems with budget deficits too. Greece, Spain, Portugal, UK. I must have put this up before those riots in France. Otherwise, probably would have had France there too. Countries that have a VAT have these problems too. You know, if we want to balance budgets, budgets are balanced by controlling spending levels, not by increasing taxes. We see that internationally. If we look across the states, the same way. You know, I mean, look at the budget problems that California has. But that's a high tax, high spending state. And I'll give the legislators in my own state some credit in Florida. We've had some pretty substantial budget cuts at the state level in Florida, but the legislature's cut spending along with the declines in revenues. Budgets are balanced by controlling spending, not by increasing taxes. So, what I conclude for all this, first of all, a VAT is too costly for the United States. It fits the EU better than it fits the United States. So I'm not necessarily going to be a big fan of it in the EU. But in the EU, the VAT was used to replace other transaction-based taxes. In the United States, we already have transaction-based taxes at the state level. The state sales tax already taxes that tax base, and so that's one thing that makes it not as good a fit in the United States as it is in the EU. A VAT would slow economic growth. And I think if we're really concerned about the budget deficit, what we need to do is to control government spending, not look for additional sources of tax revenue. And again, if I go back to that last slide, the countries that have high VAT rates aren't fiscally sound countries. So if you just look, for example, a VAT doesn't appear to be the answer to the problems that we're facing with our budget deficit. So let me close with that, and I would be happy to take any additional questions that anybody has.